Welcome back to the Video CPA. It's good to be with you. On this channel we talk about matters of taxes and accounting that might affect your pocketbook. So I'm Michael Scott. I'm your host for the Video CPA, and I am the Video CPA. So I have a master's degree in accounting. I'm a CPA. I've been a CPA for 45 years, and I'm also a certified management accountant. It's good to be with you today. Today we're going to talk about like-kind exchanges, and I need to make one point clear as we talk about this. I mean, you'll see the disclaimer that we have for affiliate programs, and you'll also see a disclaimer for education. When we talk about some of these items, especially like-kind exchanges, I mean, I'm just hitting the basics. There are a lot of other details around like-kind exchanges that can be brought into these situations, but this is the basics. This will give you a general understanding of what like-kind exchanges are all about. So if you watch this video, just understand that if you go through a like-kind exchange, that you might want to check some of the other details involved in it. So let's talk about what a like-kind exchange is. They're reported on Form 8824. That's the IRS form, and that's what you do your tax return on. So like-kind exchange actually involves the exchange of business or investment property for other business or investment property. So it's fairly straightforward. Now, in the past, I mean, we used to be able to take almost every automobile that was a business automobile or even a personal automobile, although you don't have to pay tax on a personal automobile, but a business automobile was a like-kind exchange. If you'd take that into the dealership and trade it in, it was treated as a like-kind exchange, which meant that the any gain on the trade-in of that business automobile would reduce the basis of the new property, the new truck that you were, or car that you were getting. And so all of these things were like-kind exchanges. And a couple of years ago they stopped that, so personal property is no longer eligible for like-kind exchange rules. So now it is business or trade or business property or investment property. We're talking mostly real estate in these situations. Now you ask, does your home fall into this? No. And it used to be that you could trade homes actually in a like-kind exchange, but not anymore. So the rules are property must be held, it must be real property held for trade or business or for investment purposes. Personal property, like I said, does not qualify. Property held for resale, like inventory, things like that, does not qualify. Residents don't qualify. Vacation homes do not qualify if you're using them for vacation, basically. I mean, it's got to be strictly for investment. So, sometimes I think the IRS expects you to just have the home sit there and do nothing with it. And that constitutes a vacation home. But so vacation home, if you recreate there, it's not going to qualify, unfortunately. All right. So what does qualify as a like-kind exchange? These things are described and detailed in IRS Publication 544. And they basically say that they have to be the same in character. All right. Now, so you've got real estate for real estate. That means that you can have undeveloped property for developed property, and that works. You can have city property for farm property. You can have other types of situations. You can have rental property for business type property. So the only thing you can't have is you can't exchange something in the United States for something in a foreign land and have like-kind exchange rules. Now, the benefit of the like-kind exchange rules, of course, and I should have mentioned this earlier, is that you don't have to recognize gain on these situations. So, as I mentioned earlier with the trucks that we used to be able to do, any gain that was recognized would reduce the basis of the new truck or the new car or whatever it is. So, in this case, gain is deferred until you either sell the property at some point in time or get rid of it. But you defer the gain, you don't recognize the gain, and that's the beauty of like-kind exchanges. But now they're only done for real property. All right, so let's talk about a deferred exchange real quick. A deferred exchange is where you actually give up your property to someone in exchange for a replacement property, but you don't receive that replacement property right away. So what the exchange rules say is that you've got 45 days from the time that you give up your property to identify a replacement property. So you don't have to identify it right away, but you got 45 days to identify it. And then the exchange has to be completed within 180 days from the day that you gave up your property or you transferred your property. Okay. Now there is a stipulation that it's either 180 days or it's the tax return for the year that the exchange is taking place plus extensions. So just be aware of that. But so if you do something at the end of the year, for example, the end of 2019, that tax return won't be done if you extend it until October of 2020, so the exchange could actually be carried out through that time, which is really quite a long time. So keep that in mind, and let's look at a partial non-taxable exchange. A lot of these exchanges involve what we call boot. So boot is either cash received or it's non-like-kind exchange property received. All right. So if you receive boot or non-like-kind exchange property or cash, you're going to have to recognize a gain on that. And so the gain is stipulated as the total exchange gain on the exchange, or it's the amount of unlike-kind property exchange minus the selling fees. So it could be that you've got an exchange, a gain on the exchange of $2,500, but your unlike-kind property is only about $500 when you subtract the selling fees, and so your gain is only $500. Okay, so it's the lesser of the two. Now, one other item I want to talk about here, and that is the reverse exchange rules. And I've done a few of these. When as a practicing CPA, we've done a lot of just regular exchanges because we, in the old days, like I say, every time you traded in an automobile, you had a like-kind exchange, and so you saw a lot more of those than what you did in real estate. But I've done some real estate as well, and farm property and that type of thing. So the reverse exchange is when you actually receive the replacement property before you've given up your property. And when that happens, the replacement property has to be put in escrow or parked, basically, with what's called a qualified intermediary. Now, the other stipulations still apply. You've got to the property that's going to be transferred has to be identified within 45 days, and you've got 180 days to complete the exchange. So a little bit different there. There are qualified intermediaries that actually specialize in this type of thing, and so you can go out and you need to check them out and make sure that they're a good qualified intermediary, but they do specialize in this, and there is a safe harbor in case this qualified intermediary does something with the property, that type of thing. The IRS has a safe harbor there to protect you from that. But so those are the basic exchange rules. Now we will have a more detailed course in our targeted tax training, Video CPA's targeted tax training school, which if you would like to look into that one, it'll be available. Not available yet, but will be available in the coming weeks. So appreciate your watching. It's good to have you with me today, and stay healthy during the coronavirus, and thank you again for coming and taking part.